Good morning and welcome to another episode of Edelweiss Money Konnect podcast, your go-to place for collecting investment gems from stories, conversation and book summaries. In today's episode, our CEO and MD Radhika Gupta takes us through the various behavioral financial biases that exist in mutual fund investing. She discusses 5 basic biases, how they influence investing, and most importantly, what can we do to avoid them?
How much money can you lose in the stock market? Last week, two young professionals, one aged 26 years and the other 34, both working at the same company in the same city with reasonably similar family backgrounds, came to seek my advice on investing. As we discussed stocks, bonds and mutual funds, I asked them this question, something I often ask young investors, that how much money can you lose in the stock market? So the 26-year-old said, not much, maybe 10-15%. The 34-year-old said, far more emphatically, a lot, definitely 50 to 60%. Why such a big difference in the answer to the same question, for which the data is well known, debated, discussed? I think it's simple. The 34-year-old's first experience with equities started just before the 2008 crash. The 26-year-old, on the other hand, just started investing a few years ago. The contradictory opinion between two investors is largely because of a single experience. But this experience leads to a big difference in investment decisions that they both will take. Neither is actually right or wrong, but both come with their own preconceived notions, or what you call bias that would influence their behavior. Actually, behavioral bias is not a complex sounding investment theory. It's a concept that has intrigued researchers around the world. Its core is very basic. We're all human, and just like the two investors above, because of our experiences, conditioning, personalities, we think in certain ways, we follow certain non-existent thumb rules. Be in investing or life, biases make us do things that are sometimes illogical and irrational. And today we'll learn about 5 basic biases, how they influence mutual fund investing, and most importantly, what we can do to avoid them. The first bias is anchoring. We are all shaped by beliefs which we hold on to adamantly, and with age we learn and unlearn them. However, for a few people, these beliefs are so strong that they tend to filter any view that doesn't align with these beliefs. In investing, a common way the anchoring mindset thinks is by deciding the expectation of future returns based on past returns. For instance, investors who started an SIP in mid-caps in 2017 looked at 18% or more annual returns and invest assuming that markets will do this consistently year after year, sometimes forgetting that a year like 2018 will come along where mid-caps will actually fall. In fact, after this fall, the decision to hold the SIP should be driven by a rational assessment that don't stop your SIPs at dips. The best way to handle anchoring bias is to never let one single factor, in this case, returns, drive your decision making, because there's a tendency of your mind getting anchored to it. Always view returns as an outcome of an investment journey and not a decision making driver. The other trick is to avoid evaluating portfolios frequently to tide through periods when returns are below expectations. The second bias is loss aversion. It's that simple feeling of regret that comes after making a choice with a bad outcome, and in life and money, we want to avoid losses at any cost. Losing 10 rupees is actually twice as painful psychologically than the joy of gaining 20 rupees on the same investment. The desire to avoid losses keeps investors away from equities and thus keeps them away from wealth creation opportunities. It also keeps us away from exiting subpar investments sometimes that are in the red because we don't want to realize that loss. The best way to handle the fear of loss is to adopt an asset allocation approach which strikes a good balance between risks and returns and creates a portfolio with losses that are more digestible. If you invested 100 rupees in a portfolio with 20 divided into 5 different asset classes, then even if one or two actually had a bad run, the good outcome in the other few will preserve your peace of mind. The third bias is one of choice paralysis, and we're all spoiled for choices today. Be it clothes, restaurants, phones, or money. And even worse is the fact that we're swamped with information through print, electronic, and social media. It's just time to say enough, because excess choice makes decisions tough since we are unable to decide. In the MF world, if you were to do a simple one-time investment, you can get lost in an array of fund houses and schemes for any goal or risk appetite. Finding the right scheme, if you just looked at the list, is a very tough choice. The way to avoid choice paralysis in mutual funds, as I often tell investors who ask me what is the best scheme to invest in, is to start bottom up rather than attacking 450 equity funds. Understand your goals and then filter funds based on investment objective and tenure, narrowing your universe to a limited number of funds. This will make your selection task a lot easier. The fourth bias is recency. We all remember the recent past rather than the actual past. In every bull market, we are thinking of new highs and often increasing our own risk-taking appetite because we just feel bullish. When a bear market starts, reality dawns as NAVs fall. In investing, recency bias is prevalent, especially in things like sectoral funds, which investors often buy at their peak, only to have a bad experience after investing. The best way to avoid this bias is to avoid seasonal opportunities and stick to your fundamentals. Never forget the basic check on valuations versus historical levels, and always ask yourselves 3 reasons to invest in a fund besides its past performance. The next bias is herd mentality. And we love following what others are doing, so much so that if a lot of people are at a restaurant or visit a destination or take a certain route even, it's usually considered a good one. Even if you don't have a positive view on an investment, you're often more likely to do it because of this herd mentality. This power of the crowd mentality has created many bubbles in financial services as markets run ahead of valuations because of the impact of flows and liquidity. Theme-based investing in mutual funds, the rush to risky asset classes like small caps and credit funds are often just herd mentality playing out as people look at big numbers with no reference to history or benchmarks. Herd mentality is honestly the hardest bias to avoid, and the best way to avoid it is basic fundamental analysis. Ask the difficult questions that no one is asking and don't invest till you find the answer. Biases are inevitable hurdles in making decisions, and awareness of bias is an important step, a checkbox to make sure that you're not falling into a trap. A lot of time is spent on when do I invest and what do I invest in. Do the bias check and ask a third question, why am I investing?
Don't forget to tune in to the next episode of our Money Konnect podcast. Further, these podcasts are also available on Edelweiss Mutual Fund website, Spotify, Apple Podcast, and Google Podcast for you to listen, learn, and enjoy as per your convenience. For further information on one-time KYC process, list of SEBI-registered mutual funds, and redressal of complaints, visit our website, an investor education and awareness initiative of Edelweiss Mutual Fund.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.